$1 million goes into SCHD. 10 years later, not a single dividend has been reinvested. Every quarter, the cash was pulled out and spent. So how much did that account actually pay? $527,000? In cash. Over 10 years. And here's the part that does not add up at first. The balance did not shrink. It grew to about $2.3 million. Let me say that again because it sounds like a typo. Someone put $1 million in SCHD back in 2016. They lived off every dividend, spent all of it, and reinvested none of it. Today, they have collected more than $500,000 in cash, and they are still sitting on roughly $2.3 million. That is the receipt. Not a projection, not a what if. A real, sourced result that income investors are passing around right now because it quietly destroys the line everyone keeps repeating, that you cannot actually live off dividends. When I first saw this number, I ran the math myself, twice, because it genuinely looked wrong. It is not. And once you understand why it works, it changes how you think about every dollar you are saving for retirement. Quick disclaimer. I am not a financial advisor, and this is not financial advice. Always do your own research before making any investment decisions. So here is what I am going to show you. First, exactly how $1 million in SCHD turned into a 5-figure raise that paid for itself, year after year, without ever selling a single share. Second, why the account kept climbing even while it was being drained for income every quarter. And third, near the end, what this same approach looks like if you are starting today with $250,000, $500,000, or a full million. Because the number that matters is not what one retiree pulled off. It is what you could build from where you are right now. Let me back up to where this starts. SCHD is the Schwab U.S. Dividend Equity Fund, and it is one of the most popular dividend funds in America. There is a reason for that. It holds about 100 companies, every one of them screened for quality, everyone with a long history of paying and raising dividends. To even get in, a company has to have paid dividends for at least 10 straight years. The fund rebalances and quietly kicks out anything that stops measuring up. And the cost to own it is 0.06% a year, which is about as close to free as investing ever gets. But the real magic is one word: growing. Most people look at a dividend fund and see a yield. A single number, frozen in time, that they can quote down to the decimal. The problem is that a yield is just a snapshot. What actually decides your outcome over a full decade is not the yield today. It is whether that payout climbs. And SCHD's payout has climbed, on average, by around 10% a year. Sit with what that does over 10 years. The income roughly doubles and then keeps going on the exact same shares you already own with no new money added. Now back to the receipt. Picture an investor. We will call him Harry, and everything here is illustrative based on historical performance, not a promise. He retires in 2016 with $1 million. His advisor wants him in bonds, safe and quiet. He buys SCHD instead, and he does one slightly unusual thing on purpose. He turns dividend reinvestment off. Every payout the fund makes, 4 times a year, lands in his checking account as cash. He spends it. None of it ever buys another share. This is SCHD with no reinvestment, treated like a paycheck from day one. In the early years, that paycheck was smaller. A growing fund still has to grow into its income, but year after year the companies inside the fund raised what they paid, and so the deposits hitting his account got bigger. They did not get bigger because he contributed more. He never added a dime. They got bigger because the businesses he owned were paying him more to hold the very same slice he already had. By the back half of the decade, that untouched position was throwing off far more cash than it did on day one. Add it all up across the 10 years, and the cash that landed in that account came to roughly $527,000. That averages out to about $53,000 a year. That is not pocket money. In a lot of the country, $53,000 a year is a real living, and he pulled every cent of it out to spend, the way you would actually use income in retirement. Here is where most people brace for the catch. If you spend every dividend, the account should stall or slowly bleed down, right? That is how a savings account behaves. You pull money out, the balance falls. But a dividend fund is not a savings account. It is a basket of real, profitable businesses, and those businesses kept growing in value underneath the dividends the whole time. So while he was pulling out around $50,000 a year and spending it, the price of his shares kept climbing. Not in a clean straight line, and not without pain. There was an ugly stretch in 2022 when almost everything fell at once, and holding through that took real nerve. But across the full 10 years, the value of that $1 million position grew to about $2.3 million. He spent the income, and the principal still more than doubled. It grew by roughly 130% while being treated like an ATM. This is what I call the receipt test, and it is the framework I want you to remember. Most income ideas fail at least one part of it. A high-yield product might hand you a fat check, but the principal quietly erodes, so you are really just being paid back with your own money. A pure growth fund might build a huge balance, but it pays you almost nothing to actually live on along the way. The receipt test asks for all three things at once. 1. Real cash you can spend today. 2. A balance that holds or grows. And 3. A raise that shows up every year without you lifting a finger. Over this stretch, SCHD passed all three. And that third one, the raise, is the part almost nobody appreciates until they see it on paper. His income in the later years, measured against what he originally put in, was dramatically higher than where it started. That is called yield on cost, and it is the quiet engine under this entire thing. The market can do whatever it wants in any given year. The raise tends to keep coming anyway, because it is driven by companies growing their profits and sharing them, not by where the share price happens to sit. And here is why that raise is more reliable than it sounds. The companies inside this fund are not speculative names hoping to pay you someday. They are established, cash-generating businesses with long records of writing checks to shareholders through good years and bad. When one of them stumbles or freezes its payout, the fund's quality screen eventually swaps it out for a healthier payer. So the income stream is being maintained for you, quietly, in the background, without a single phone call or decision on your part. That is what made the holding part possible. Spending the dividends is easy when times are good. The real test came in the down years, when the headlines screamed and the balance dropped on paper. The people who panicked and sold locked in the loss and killed the raise. The ones who simply kept cashing the dividend checks and held their shares let the recovery do its work. Doing nothing on purpose turned out to be the entire strategy. Now let me show you the comparison that really lands, because this is the moment that flips how people see the whole strategy. Imagine our retiree had a neighbor. Same million, same fund, same year. But the neighbor flipped one switch the other way. He reinvested every dividend instead of spending it. Every single payout automatically bought more shares. The neighbor's balance today would likely be higher. The estimates put a full reinvestment path somewhere near $3 million, give or take. So call it $700,000 to $900,000 more sitting in the account. On the surface, that looks like the obvious winner. But look closer at what the neighbor gave up to get there. He received zero cash to live on. For 10 straight years, not $1 of that money paid a bill, covered a trip, or handled a medical surprise. It all stayed locked inside the fund, growing a number he could not touch. The spender took a very different deal. He collected more than $500,000 in spendable cash over the decade, and he still walks away with $2.3 million. Add the cash he pulled to the balance he kept, and he is sitting on close to $2.8 million in total value. The reinvestor built a slightly bigger number on a screen. The spender built a life he could actually fund the entire way through, without ever selling a share to do it. For someone who is accumulating, reinvesting wins. For someone who needs income now, living off it is not even a close call. So, what does this look like if you are not starting with $1 million? This is the part that matters most for almost everyone watching. And a fair reminder here, these figures are based on historical performance and are not guaranteed. SCHD today yields a little over 3% on its current price. Start with $250,000. At that yield, you are looking at roughly $8,000 a year in income right now. Let that payout keep growing at its historical pace, and in about 10 years, that same position could be paying somewhere around $21,000 a year, with you never adding another cent. Step up to $500,000. Your starting income is around $16,500 a year. and it could potentially grow toward $43,000 a year a decade out. And at a full million today, you would start near $33,000 a year, on track to potentially reach roughly $85,000 a year if the payout keeps climbing the way it has. Notice the shape of those numbers. The starting figure is modest, the ending figure is not. The whole gap between them is the raise doing its work quietly in the background, on shares you never had to touch. There is one more piece that makes this hit even harder than people expect, and it is taxes. Most of what SCHD pays counts as qualified dividends. That means it is taxed at the lower long-term rates, not at your regular income rate. For a retired couple with modest taxable income, a real chunk of those dividends can be taxed at 0% at the federal level. Compare that to the interest from a bond, a CD, or a savings account, which is taxed as ordinary income at your full rate. The income you actually keep can be meaningfully higher, off the very same headline number. That is the difference between the safe, quiet path the advisor wanted and the one that actually paid. And the engine is still running. Recently, 18 of the companies inside the fund raised their dividends, and not a single one cut. That is the raise machine, still turning, right when income investors need it most. Now, is SCHD the only tool for this? Of course not. DGRO is a solid companion, younger companies, similar growth discipline, and it sits comfortably alongside SCHD. VYM offers a higher current yield, but it overlaps with SCHD by around 86%, so owning both does not really diversify you much. SCHD just happens to sit at the center of this particular strategy, because that growing, mostly qualified dirt cheap income is exactly what a spended approach is built on.